Right, good evening, guys. I'll just give the others a few minutes before we can start. Okay, so I see two of you online. Akib and Keshan. So, Akib, I know you're sitting for the paper in September. What about you, Keshan? Are you sitting for FM in September? Are you there, Keshan?
Yes, ma'am. Yeah, I'm
Okay,
sitting.
you're sitting in September. Okay.
Yes.
Okay, so in case there are others who want to join, I'll give them a minute. Yes, Akib, doubts? Yeah, you can ask me on WhatsApp, but the issue is I'm having a lot of messages. It always happens, right? 1 month before the exam, because I have MA as well as FM, right? So in case I end up not answering to it, you can ask in the TRG, because you can, it's just a one-way communication. This is two-way. So that's the issue. Okay. What else? Because to be honest with you guys, I'm not very sure as to who is sitting for papers and who isn't. Okay. So I mean, I will get that data soon. Yeah, no worries, Keshan. Okay. So I will get that data soon. That's, at that point only I'll be able to figure out how to properly, plan out this revision. Okay. Because I know some of you are watching recordings, but again, I don't know how far through you are with the recordings. So until I get that data, I will, do something on the surface. After that, if there is anything specifically that we have to cover, we can do that as well. Okay.
Excuse me.
Yes.
This 30-day study plan thing on the the LMS, was it prepared by anyone?
Yeah, it was prepared, right? I think it's uploaded, isn't it?
It is uploaded. It is quite useful.
Okay. But Akib, like, I mean, see, I prepared that with the intention of someone who hasn't studied anything at all, right? So if you are ahead of the study plan, by all means, like stay ahead. Okay, don't now if if you've already done questions, don't just slow down because of the study plan. Got it?
Got it, got it.
Right. Yeah, so that's good, Akib. Now, if you have questions in the practice platform, then do that. Because see, Akib, in your case, you have been studying this paper for a while now. Okay, so now I'm sure most of the basic stuff you will already have a good grasp of it. So definitely you're getting a 50. Okay, so after this, you have to start thinking about how am I going to increase my mark. So that's when you start, doing all the different types of questions. You will have small areas that you wouldn't have seen in the past. Try to learn them as well. Okay, so you're in a good position to do that. So you can aim for a high mark, right? But when it comes to this TRG, I will be focusing on not, I wouldn't say the bare minimum, but definitely I have to focus on what has to be done for you to get at least that 50, 60. Okay, because some of them are working, some are, halfway through the syllabus. So in that case, what do we do? Right? So like I said, the study plan as well as the questions that we are doing in the TRG Akib, you might find it easy. In that case, by all means, go ahead and practice more as well. Okay, because I know, I mean, since I've been following you, I know what you have been doing so far. So if you feel that there is more and, you can actually do more, then go ahead and do that. Okay. Right. So for those of you who will be watching online as well, let me just quickly run through what this subject is about. Okay. So give me a minute. And I'll tell you what I have planned for the TRGs, right? So this is 171, right? So if you look at the exam kit, guys, you will see that FM has been properly divided into separate areas. Okay. Now I will tell you this. We tend to get carried away by the section C. Okay, because section C, we think it's hard because I hope you know, right? The paper has 3 sections, section A, section B, section C. A and B is entirely MCQs. C is the one where there is constructed response, right? So what happens is students tend to kind of practice a lot of section C questions because of the mere fact that they're scared to type answers in a spreadsheet, scared to answer theory-based questions on a word processor. Okay. So because you're scared in the first place, you end up trying a lot of questions, right? But the fact of the matter is, guys, people tend to fail this paper because of section A and section B. Okay, I'm sorry about that, guys. Something to do with the streaming. Okay, but since it happened early on, it's good. In case it happens again, don't worry, I will join. Okay. Right. So what I was saying was, yeah. So what I was saying was, when it comes to this paper, right now, I'm going to focus entirely on exam technique, right? So when it comes to this paper, like I said, section A and B is the area where students tend to fail. Now, the reason for that is, guys, if you look at your revision kit also, the number of questions that you have to attempt in terms of an MCQ is actually relatively small. Okay, now you can see there are a few MCQs over here. I'm sure all of you will be able to finish it before your exam. But it's not a lot. When you compare that with the section C, there are lots of questions also for you to attempt. Okay, so don't get carried away with that. I'm not saying don't do section C, do section C, but at the same time, do these MCQs at least 2 times. Okay, so by 2 times, I mean do it in a short span of time. So for example, if you're starting it today, which is a Monday, try to finish off all the MCQs from the MCQ number 1 to the last MCQ, maybe by tomorrow or day after tomorrow. Do that about 2 times. Maybe do it once this week, do it once next week, and then that will kind of stick to your head, right? Because if you get carried away with section C, understand that you only get 40 marks there. That's the truth, right? You only get 40 marks there, 20 plus 20, 40. Even if you get the entire 40, that's not enough for you to pass. So where is the bulk of the mark? The bulk of the mark is actually in the MCQs, right? So please focus on the MCQs, because if you don't know how to deal with these tricky questions, you will realize, right? When you do an MCQ, you get an answer, you choose it, but that's the wrong answer. Okay, so the only way you can properly learn from the MCQ is to do it about 2, even 3 times, I would say is perfect, because that will help you tackle the first 60 marks of your paper. Okay, so just wanted to put that forward. Yeah, the study has ACCA, but the study text, the style of questions and the questions that you get in the revision kit and the exam is different. Okay, because in the study text, they focus on trying to make you understand a particular area. Okay, like for example, if they're teaching you investment appraisal, they just want you to learn how to do, for example, a working capital adjustment. Okay, but that's not the exact way in which they will test in the exam. So instead of relying on the study text at this point, if you know theory and if you know the calculation.
No, the study text, study hub.
Sorry?
Study hub actually.
Yeah, Study Hub also has. Yes, Study Hub has. Study Text doesn't, right? So don't rely on Study Text at this point, because those questions have been designed with the intention of making you understand the topic, and that's it. That and the exam style is two very different things. Okay. Keshan is saying you haven't done much of C-type questions. You're afraid on part C. You can't rely only on B and A, Keshan. I'll tell you why that is, right? Because honestly, they're not easy marks. C is easy marks. Okay, because if you know to do a calculation, now we will do examples today. If you know to do a calculation, easy 8 to 10 marks you can get. If you know a little bit of theory, easy again another 6 marks you can get. Whereas when it comes to section B and A, they are not necessarily easy questions. It's easy to attempt because it's an MCQ, it's not lengthy. But if you rely on B and A, that's going to be difficult for you. Okay, so take my advice. Do the entire MCQs 2 times. Okay, I know you're working, so do it 2 times. And the remainder of the time, don't only focus on one area. I will show you how to do that as well. Do a few section C questions as well. So I will be doing certain areas. At least the ones that I do in the TRG, you have to know how to do. Okay, because you can't, it's like this, right? You need 50 marks. If you're going to rely on 60, that means you have to be so confident that almost all your answers in the MCQ has to be correct, which is very unlikely. Understood? Okay. Right. So let me look at the syllabus, right? So I'm sure all of you know this at this point. So there are distinct areas that, they tend to test from. So the first one and the easiest one, everybody likes this area, is actually investment appraisal. Okay, so although in the revision kit it comes third, when we are doing the study hub, this is the one that comes first, right? So investment appraisal, I'll tell you this very clearly, right? You have to know how to do the NPV calculations. Okay. When it comes to NPV, there were 3 separate adjustments, one for inflation, one for working capital, one for taxation. You have to know these 3 adjustments. Okay, that is the basic type of NPV. We will do a question today also. Okay, then there are certain niche areas, I like to call it. Niche means I'm saying there is a chance that you can get this. Now, if you get the main NPV, like if there are 10 papers, probably 7 papers, you will get the main NPV, right? But there will be 3 papers where they will ask you certain different areas. One of them is the lease versus buy option. Because lease versus buy, although it's about leasing and buying, and or whether you have to borrow or whether you have to lease, end of the day, the calculation is similar to NPV. It is trying to get a present value, right? So that is one area they can ask. The other one is the equivalent annual cost area. Okay, so for example, are you supposed to replace a machine every 3 years, 4 years, 5 years? Okay, so that is another area where they can ask. Now, I can tell you for sure, if they ask you lease in the question, they won't ask you EAC. If they ask you the main NPV, they won't ask you EAC. But one of these 3, somehow they might incorporate if one of the section C is a investment appraisal question. Okay. Now for Keshan, who said, I haven't tried questions, right? So there is 2 main questions I want you to try. One is this Raxin and Hayback. Okay, I don't want to do it today or in the TRG because I have done it multiple times. Even in class, I have done it. So I don't want to, do the same question. I'll try something else out. But these 2 questions, they have all the adjustments you need for the main NPV questions. Okay, so do those 2 plus start working from down, right? So start with the March, June 21, that is Cabrera's, Crockett, Pinks. You keep on going upwards. Okay. So the plan for you, Keshan, will be probably try at least 2 questions from every area every day. Okay, so if you do 2 from investment appraisal, then go to the next area. Then again tomorrow, 2 from investment appraisal, then another area and another area. Don't try to do investment appraisal on one day, working capital on another day. And then by the time the 5th day is over, you can't remember what you learned in investment appraisal, right? So that's the first area which we will focus on today. Okay, so in the TRG, we will do 3 questions. 2 will be constructed response. 1 will be an MTQ. Because section B also, I told you, we have to be a little careful. So every class, the plan will be 2 main questions plus 1 MTQ based question. Okay. So then comes the next area in our syllabus. It was this business finance and cost of capital. Okay. Now, I can't emphasize this enough. This cost of capital chapter is very, very important. Okay. So like I said, if you don't have time, maybe you can skip this June 7, December 7, because they're pretty old, right? But the newer questions, please make sure that you actually try it out before the exam. Okay. So cost of capital business finance, we will cover next week. Okay. Then we have the next area we will look at is risk management. Now, risk management, when I teach this also, I say there is a good tendency to ask questions in the exam, but most of the time they tend to be MTQs and MCQs. You can see even here, there is only one example where a section C has been based on risk management. Okay, so again, the 3rd week of this month, we will look at risk management in detail. Finally, the last week, we will look at business valuations. Okay, so business valuations actually goes hand in hand with cost of capital. Okay. So basically, the day that we are doing risk management, I will cover another area, which is also a major area. It's working capital management, but working capital management is relatively easier compared with the other areas. So that's why we will combine that with risk. Okay, so we will try our best to do as many questions as possible. Okay, so that's the plan for the TRG. In addition to this, guys, I think on the 12th. Okay, so that is, let me check the dates. Yeah, today is the 5th, yeah. So next week, hopefully by next week or the week after that, you guys should be done with your, everything that you have to do with studying, and you should start getting into the mood of doing exams, right? So make sure that you take 2 mock exams, you practice it under timed exam conditions. That will definitely help you out. Okay, right. Finally, this financial management function and environment, that is very rare to get a question in section C. You might get in the MCQs, but even if you get it, you should be able to, use your general knowledge and answer that. Okay, so that's why we are not going to dedicate a day just for that. Okay, so let me be honest with you, 4 days is very little time, but still we will try to do as much as possible. Okay, Right. So before I start, I'll tell you the questions I'll be doing today. I'll be doing a question called PELTA, another question called DINK company, and another MTQ called Bell company. Okay, so those are the three that we will do today, right? So I'll just take 10 minutes of your time, quickly refresh everything to do with investment appraisal, right? And then we can directly start the questions. Right. So first thing is, there is a chapter where we focus on investment appraisal techniques, but not using cash flow based methods. Okay, so we use profits to decide whether or not to go ahead with an investment or not. Okay, so there are only two different techniques that we learn here. One is the ROCE. Okay, we call it the ROCE or the accounting rate of return. Either one, we are referring to the same. There were two equations which you have to know. I'll be honest with you, ROCE calculation is very, very rare in the exam because it's a short calculation. So you can't give 8 marks for this, right? So if at all you get it, most probably it will be in an MCQ, right? So we start off with that and then we look at another technique where we are not going to, we say that, using accounting profits is not good because we can manipulate it. And then we go ahead and use what we call payback. Payback means we are going to look at the cash flows, but we are going to consider how long it takes for us to earn back our initial investment. Okay, so that is just entirely one area, calculation of ROCE, calculation of the payback. Okay, then comes the next chapter where we say that we, in the ROCE as well as the payback, we have not considered time value of money. Okay, we don't discount anything. We are not considering time value of money. So we will say that the decisions that you take may be inaccurate. Okay, so then we come up with another technique where we consider time value of money, and that's the NPV, the net present value. Okay, and then in that same chapter itself, we talk a little bit about how to calculate IRR as well. So IRR, nothing much. You just have to know how to apply the equation and calculate it. You should know how to get two NPVs and two discount rates. Okay, so that's basically it here. Then I told you NPV again is an area where they focus a lot on. So you can't expect them to ask you a simple NPV based question. There can be questions where they will tend to give you adjustments. Okay, so three main adjustments you have to know. One is taxation, the other one is inflation, and the third one is working capital management. Okay, so those three adjustments you have to be very good at, because if you're getting an NPV based question, it will be including at least two of these adjustments. So maybe not all three will come, but at least two will definitely be there. Okay. Right. So now, can you remember I told you that there are certain niche areas when it comes to investment appraisal? Okay, meaning certain areas where they can test once in a way, they will test it. It's not like they will never test it also. Okay, now for example, financial management, environment and all, you can to some extent say it's not very important, right? But these areas, definitely one of them, they will somehow push it into the paper, right? So you have to be careful here. One is you should know how to do capital rationing. Okay, so how to calculate profitability index numbers, okay, how to decide if it's mutually exclusive, if it's indivisible, which project should we go ahead with. You should be good with that part, capital rationing. The next part you have to be good at is equivalent annual cost. I mentioned this earlier also. There are certain situations where you have to apply this equation, that's the present value of cost divided by the annuity factor, and decide what is the best replacement cycle. Now, why do they include this? Because when you're getting this present value of cost figure, you have to do an equation, a calculation similar to NPV. Right, so even if they don't ask a main NPV question, NPV calculation will be covered in this EAC. So that's why I'm telling you there is a chance that they can somehow push this through, right? So the question that has this is actually the last question in the list, right? This Cabrera's company. It has EAC. I wanted to cover it today, but unfortunately, I don't have time, right? So that's why I'm just covering PELTA and DINK. That is, I will look at the main NPV as well as lease versus buy. But please make sure that you have a look at this Cabrera's company, because that's where they ask you about EACs, okay? Right. So that is the second bit, the EAC. Finally, you have to know the third area, which is the lease versus the buying option. Okay, so if you have to buy a new machine, are you going to borrow money and buy it, or are you going to go for a lease? Okay, so this particular area I will look at in the TRG today itself. Okay, so this chapter, what's this chapter? Chapter 6 is where you have the niche areas. They can test expected values also, Akib. Okay, so I'm coming to that as well. I'll give you an example also of a question where they test it. So the last area is in investment appraisal, project appraisal under uncertainty. Okay. So here they can first thing, they can ask you to do a sensitivity analysis. Okay. That they can do. Okay. Next is you can see this expected values area. Now simulation, what else? Probability analysis, simulation, as well as sensitivity analysis. They can ask you to explain in words also. Okay, because for example, simulation, you don't know how to do the calculation, but they can ask you to explain that in words. Okay, so that is there. Then when it comes to expected values, guys, how this gets incorporated is in the NPV, there will be a particular, some sort of a probability going on. Okay, so before you start the question, you might have to do this expected value calculation also, right? So let me just give you a question where they talk about that. Let me check. $139. Yeah. So there is a question called Degnis Company, which is question number 280 in your revision kit, page number 139. Okay. So that particular question, they incorporate expected values with the, what you call NPV calculation. Okay. So that's how they will never ask for direct expected values. It will be incorporated into NPV. Okay. So that is the last part that you have to know about. Let me check if I covered everything. Yeah, and then we look at risk-adjusted payback and discount rates. We have we have a question in this TRG itself to do that. So I'm sure we will cover it today, right? So yeah, that's basically the investment appraisal chapter. So if you can focus on all of these areas, you should be good to go, right? So let's start with our questions. If not, we will run short of time. So I told you we'll start with PELTA, right? So that is page number 143 in the revision kit. Where is that? Yeah. So let's read what it says. It says here, I'll give you a minute. You can go through it while I set up my Excel sheet. Okay. Oh, one more thing, guys, an important thing. I know most of you must be using Excel to do your calculations, right? But do get used to the spreadsheet that they give you in the exam. So basically what's there in the practice platform, right? Because all the options that you have on Excel, you don't get on that spreadsheet. Okay, so get used to their spreadsheet also. If not, if you try all your questions in Excel, you will have a problem when you have to face that spreadsheet for the first time in your exam. Okay, so get used to it using the practice platform. Okay, so let me read it. Okay, so it's saying here, the directors of PELTA, okay, so we know that the company is PELTA, are considering a planned investment project costing 25 million payable at the start of the first year of operation. So usually initial investment, even if they didn't tell us that, we will assume that it happens in the beginning of year. I mean, it happens in year, not at the beginning of the investment only. Okay. The following information relates to the investment project. So they're saying in year 1, we will have sales volume of 520,000 units per year, 624,000 in year 2, 717 in year 3, 788 in year 4. That's fine. Selling price, it's going to be $30 throughout. Variable cost will be 10, 10.2, 10.61, 10.93. And they're giving us the fixed cost also. They're saying 700,000, 735, 779, 841. This information needs adjusting to take account of selling price inflation of 4% per year and variable cost inflation of 3% per year. So I told you this, one of the adjustments for NPV is the adjustment for inflation. Okay, so they are telling you also selling price you have to inflate by 4%, in variable cost you have to inflate by 3%. The fixed costs which are incremental are related to the investment projects are in nominal terms. So nominal terms means money terms. We have already included inflation. The year 4 sales volume is expected to continue for the foreseeable future. So this project is not ending with year 4. We are going to have more years to come. Pelta company pays corporation tax of 30% 1 year in arrears. That's what usually is the case. The company can claim tax allowable depreciation on a 25% reducing balance basis. So again, NPV based question, they are giving you the taxation adjustment also. The views of the directors of Pelta company are that all investment projects must be evaluated over 4 years of operations with an assumed terminal value at the end of the 4th year of 5% of the initial investment cost. Right. Now, what they're saying here is, now, if you have done previously, if you have done questions before, you will see that they say, okay, this particular project has a life of 4 years. Okay. In this case, it's something else. Usually, this is what we see. They say the project has a life of 4 years and there'll be a scrap value of so much. Okay. But in this question, it's a little different because they're saying we are going to assume that 4 years it's going to operate, and then after that in the 4th year you will have a terminal value. Terminal value means similar to a scrap value of 5% of the initial investment. So that 5% is not the real scrap value, right? Because we are not selling the machine or anything, because even beyond the 4th year we will have operations. Okay, so here we are making an assumption. Usually we don't, we actually put the real figures, but in this case we happen to be making an assumption. So keep that in mind, that if something new is happening, you might have to talk about it in the question. Both net present value and discounted payback must be used with a maximum discounted payback period of 2 years. So we have to calculate most probably NPV as well as discounted payback. The real after-tax cost of capital of Pelta company is 7% and its nominal after-tax cost of capital is 12%. Okay. A part is saying, calculate the net present value of the planned investment project. Okay, I'll read everything. The second part is saying, calculate the discounted payback period of the planned investment project. Then they're asking you to discuss the financial acceptability. And C part is saying, critically discuss the views of the directors on Pelta's investment appraisal. So see here, 6 marks just for theory. Actually, not 6, 7, 8, 9 marks, right? Even the B part is some discussion. So 9 marks, exactly almost half and half, right? You get 11 marks for calculations and 9 marks for theory, right? So if you're not going to be good at putting your points properly, that's a problem. Okay, right. So I'll give you a minute, okay, to do just the inflation adjustment. Okay, so they're telling me selling prices you have to inflate by 4% per year, and variable cost you have to inflate by 3% per year. So you have the selling price over here, you have the variable cost as well. See if you can do the inflation only. Okay, and then we will set up the NPV structure. Sorry. Okay, so let me show you how to structure stuff. Okay. So in your exam, you just have a spreadsheet. You can't open different sheets right now, like how in Excel you can do this, right? You can't do it at your exam. So whatever you're doing, you have to do in that one sheet that you have. Okay. So I know that NPV calculation I will have to do after certain workings. Okay. So let me put the workings first. Right. So I have the sales volumes, which I can just put here. Year 1, year 2, year 3, and year 4. Okay. So in year 1, it is 520,000. Then here it's 624,000, 717,000, and 788,000. Okay. So then I can put in my selling price also. So as much as possible, formulate, right, in your exam. So then even if you change a few numbers here and there, it will automatically change. If not, you have to manually go back and change everything. But if you're not familiar with formulas, try to learn it over this particular month. Still, if you end up being not familiar with it, then feel free to just put the figures in. Okay, use your calculator, get the inflated figure and put that in, no problem. Okay, I'm saying it's good to use formulas, but if you're not good with formulas, don't take that risk. Okay. Right. But guys, get used to it, right? Because you guys are accountants, at one point you have to be able to work with it. Okay, so inflated by 4%. So let me inflate. Now they're telling me the information needs adjusting to take account of selling price inflation of 4% per year, right? So these selling prices have to be inflated by 4%. Okay, so let me do that. That's 31.2. So I'm just formulating the way I like to, right? It's up to you to decide how you're going to do the formulation. So what I like to do usually is I will formulate the first, like 30 into 1.04, I get that answer. And then I will multiply the next cell by 1.04. Okay. And then I can drag it now because then it will happen to all the different cells, right? So that will be 32 point. Okay. So let's, these too many decimal places. So these are too many decimal places. I will put it to just 2. Okay. So 31.2, 32.45, 33.75, 35.10. Okay. So in case any of you want to know how these answers came about, give me a minute. Okay. So this is basically 30 into 1.04. Okay. So this 31.2 is 30 into 1.04. This figure is 30 into 1.04 squared. This figure is 30 into 1.04 cube. And this figure is 30 into 1.04 to the power 4. Okay, so that's how you usually inflate. When you're formulating it, if you do, instead of putting this squared and to the power 3 and to the power 4, what you can do is you can, make it automatically take the previous sales figure and multiply it by 1.04. But like I said, if you're not familiar, use the cal, get your answer. It's fine. As long as you put the numbers in, that's what's important. Okay. Right. So now let's get the income that you're going to generate. Okay, so income. Let's see how much we're going to generate. That will be this figure, 520,000 into 31.2. Okay, so I can see that it's a big number, right? So I can do this in thousands just to make it smaller for me. Okay, so let me just put this as 520,000 into 31.2. It was some in the millions, right? So what I will do is I'll just put it as a 1,000 based figure. So that will be 16,224. Okay, so here 624 into 32.45, that will give me 20,248. 717,000 into 33.75 will give me 24,196. And 788,000 into 35.1 will give me 27,655. Okay. So this I did it manually. If you wanted to formulate it, what you would have to do is basically put sales volumes in thousands. So instead of putting 520,000, just put 520 and put this in brackets and thousands next to sales volume. Okay. So then when you do the formulas, it will give you your answers the way, in a shorter way, right? So let's bold that because that has to go to the NPV statement, right? So that is the first working where we got the income. Okay, so let's call this sales. So the next working we will have to do is that of variable costs. Okay, so let's do that. Right, so I'll copy these sales volumes, okay, because that won't change. Then they're saying the variable cost is 10, 10.2, 10.61 and 10.93. Okay, so I have to inflate this every year by 3%. So that will be percent. Ten point two, 10.61 and 10.93. Okay, so let me inflate this. They said variable cost inflation is 3% per year. Okay. Okay, so that will be this into 1.03. Can drag it across because all of these numbers are already getting inflated, right? So that will be 10.3, 10.5. Let me check. 1 second. No, it's not doing it, right? Because we haven't included the second year. So let's do it manually itself since the numbers are different. So that will be this into 1.03 to the power 2. That will be 10.82. Then here it should be 10.61 into 1.03 to the power 3. And the same thing here. So careful there because as it is, the costs were increasing. So we have to take into account that plus the fact that there will be an inflation every year. So we have to do it every cell separately, right? Let me bring this to 2 decimal places. Okay, so it should be 10.3, 10.82, 11.59 and 12.30. Okay, so now I can get the variable costs. I'll do that also in thousands. Right. So 520,000 into 10.3 will give me 5356. 624,000 into 10.82 will be 6752. 717,000 to 11.59, 8313. And 788,000 into 12.3 will be 9,694. So this also has to go to NPV calculation. So let me bold that as well. Okay. So we have done the adjustment for inflation. Now the next adjustment we have to do is that of taxation, right? So let me put that in as well. Right. So they're saying here, Pelta company pays corp tax of 30%, 1 year in arrears. The company can claim tax allowable depreciation on a 25% reducing balance basis. Okay. So this is the classic tax allowable depreciation adjustment. Okay. So I'll give you a minute. See if you can figure it out. So there was a structure. If you use that structure, you will be, it's easy for you to figure out what to put into the NPV statement. Okay. So have a go at it. You have to be careful with 2 things. One is the tax relief itself. The other one is the timing of the tax. in case you guys want to copy it down. Huh? So if you haven't copied, copy down these two workings and then try the taxation adjustment. Yeah, that's okay, Aki. Okay, so don't worry about these decimal places and stuff because anyways, it's constructed response. So the examiner can see all your workings. So that shouldn't be a problem. But, make it neat in the sense, like bold certain things that you want him to see. Okay. That will, if you make it easy for your examiner to mark, what will happen is he'll end up he has a chance to actually give you more marks. Whereas if it's a big mess and different values in different places, he will try his best to give you the mark. But if he misses something, then it's missed. You can't help it, right? So always think about how you're going to plan it because anyway, it's a spreadsheet. You can cut and paste and do whatever you want. So it's not like those days, we had to make sure you leave the first page for the NPV calculation. Then the next page, you do the workings. You don't need to do all of that. Right? So you can work the way you're working and then after you're done with the question, make sure you properly put it in a way that it's easy for him to understand. Okay. Okay, so let me do the taxation adjustment, right? So to do taxation, you need the structure. Okay, it says years. Then you have to mention the type of cash flow, the tax savings, and then the timing. Okay, these columns, if you have, it makes life easier for you, right? All right, so in year naught, which is today, you are going to make your investment. Okay, you're going to make your investment of 25 million. Okay, so let me do it in thousands itself. I'll put it as 25,000. If you're doing anything in thousands, don't forget to mention that. Okay, so 25,000. Then what happens? I told you this, right? When we did this chapter, tax allowable depreciation usually will be claimed in year one. Okay, tax allowable depreciation usually will be claimed in year one unless in the question itself they tell you claim tax allowable depreciation as soon as possible. If they say claim it as soon as possible, then today itself in year naught itself you will claim. But otherwise, under normal circumstances, tax allowable depreciation will be claimed in year one and the first tax savings for year one, whatever you have as a tax savings, you will actually realize it 1 year later. Why is that the case? Because we are paying 1 year in arrears. Okay, so two things you have to remember. First is you claim tax allowable depreciation in year one. But the year in which you actually, you're able to enjoy the tax savings will be 1 year later because you're going to pay tax in arrears. So if you're going to pay the tax relating to year one in year two, then any savings you make on taxes relating to year one also will happen in year two only, right? So you have to be a little careful with the timings there. So tax allowable depreciation, I think it was 25%. So that will be 25% of 25,000, which is 6,250. Okay. So this 6,250 only, you will get a tax savings that is based on your corp tax rate of 30%. Okay. So 6,250, you multiply that by 30%, that will only be your tax savings. That will be 1,875. And the timing, when will this happen? When will you realize this 1,875 savings? 1 year later in year 2. Okay. So that's it. Then you need to have the written down value after that for year 1. That will be 25,000 minus 6,250, which is 18,750. Okay, so year 1 is done. Then year 2, same thing. Yeah. Okay, so usually if you're paying 1 year in arrears, you will claim the tax relief. Now, if the tax allowable depreciation was calculated in year 1, you will claim it also in year 2, the next year. Okay. But if you're going to pay immediately, now, for example, they say taxes are paid in the year in which they arise, then the year in which you claim tax allowable depreciation, which is year 1, that year itself, you can claim the tax savings. Okay. So in this case, we are claiming it 1 year later because of the fact that we're paying in arrears. Okay. Right. So that's that. So now let's do again tax allowable depreciation at 25%. So that will be 4687.5. I'll make that, I'll just make that a whole number, 4688. So this figure into 30. That is 1406.25. The timing will be year 3. Okay. So then again, written down value. So then same thing you do for year 3 as well. Tax allowable depreciation, 25%. And the tax savings will be 30% of that tax allowable depreciation figure. Year 4. Okay. Then you have your written down value as well. Right. So 10,400, so 547, right? Now till this point, it's fine. Now the issue is in year 4, something different is happening in this question. So what are they saying? In year 4, they're saying we are going to assume that there will be a terminal value of 5% of the initial investment cost, right? So in T4, we are going to have a terminal value. That's new. Usually that's not the case. And how much is that? It's going to be 5% of your initial investment cost. So that will be 5% of initial investment was 25,000. Let's check how much that is. 1,250. Okay. So that you have to deduct. So let's take the final figure over here, which is 9,297, right? Now this 9,297 only, you will be able to claim a tax relief again. That will be 30% of this figure, 9,297. So if you remember, whenever there was a disposal, we usually put scrap value here. We deduct it and then we say, okay, this is the balancing allowance. So here, instead of putting the scrap value, you're putting the terminal value. That's about it. Okay, the balancing allowance. Right, so that 2,789, you will claim it 1 year later in year 5, right? So let me just make all of these figures whole numbers. Right? So these numbers, right? If you want, you can bold this. This has to go to the NPV calculation. Okay? Right, we'll see if there are any other adjustments. We have done the taxation, inflation is done. That's it. I don't see any other adjustments, right? So I can go ahead and do the net present value calculation, right? Take this down, taxation if you haven't, and then we'll do the net present value. So the only adjustment we haven't done in this question is for working capital. Okay, so that's what I'm telling you. Try HABAC because that's the question where you do all the adjustments that are pertaining to NPV. Right, so now let me put in all the numbers that I have to, right? So we start with the sales income. Copy all of these. Okay, so this is year 1, year 2, year 3, year 4, and it's better to have a year 5 as well. Okay, so this is your sales income. Then after that, let me take down the variable cost, which was here. Okay, then what else do I have, right? So now when I see the sales and variable cost, I'm tempted to do something. I'm tempted to take the contribution figure. Okay, it's not important if you didn't do it, it's fine. But when you have a sales, you have the variable cost. Sales minus variable cost is anyway contribution. No? So it's good to have a total here saying contribution. Okay, so let me just deduct the 2 and get contribution. Okay, so that's for all the years. Then I have a fixed cost in the question, so I can't forget that. Everything I'm doing in thousands. NPV itself is in thousands, so I'll put that also in thousands. So that is 700, so I'll put it as 700, 735, 779, and 841, right? So now I can go ahead and take a total again. The contribution minus the fixed cost. Do that for all the years. Okay. Right. So now we call this the cash flow before tax. Okay. Now in the NPV calculation, although, in real life, we don't do it this way. Soon after we get this cash flow before tax, we calculate the tax figure. So that's going to be at 30%. Right? So the thing is, we can take 30% of 10,168, but we have to be careful with the timing because 30% of 10,168 is not paid in the same year, it's paid the following year. Right? So the tax payment, it will be 30% into the previous year's cash flow. Okay, so that will be 30,050. So you can drag it across. Okay, so this 3,828 is 30% of 12,761. Then 13% of 15,104 is only 4,531. And 30% of 17,120 is 5,136. Okay, so be careful with the timings. Right, so that's the tax. Then there was a tax allowable depreciation tax savings. right? This tax savings on tax allowable depreciation, you can go ahead and include those figures. So you can say tax savings from tax allowable depreciation. So in year 2, the timing, be careful. In year 2, it's 1,875. I'll just type it here. Year 3, it was 1,406. Year 4, it was 1,055. And year 5, 278. Put the figures in. Okay. So those are the only two adjustments. There wasn't any other adjustment we have to consider. So we can go ahead and take another total here before we include the investment. Okay. So here it will be just 10,168. It will be this figure. Tax is a expense, so deduct it. Tax savings is a saving, so you have to add it. Okay, so do that for these three. And here be careful, because this is a outflow, right? 5,136 is an outflow and this is an inflow. So overall, that will give you a negative figure of 2,347. Okay. Right. So those are the total. So we can call this the after-tax cash flows. You can put these as negative figures, right? Like you can write it as minus 3,050, but if you do that, you won't be able to formulate it. Okay, so that's why we're just putting it as a normal number, and then we are in our formulas, we are deducting it. Okay. So then we have the after-tax cash flows. Anything else that we have to consider? Let me see. That's about it, right? So we just have to look at the terminal value. So we are supposed to have a terminal value of 5% of the initial investment cost. So I think we calculated it was 1,250. So I'll just go ahead and include that as well. 1,250. Just give me a minute while I check the totals. Okay, so 10,168, 11,586. 17,120 minus 4,531. Yeah, plus 1,055. Give me a second. I'm getting another figure in the revision kit. $13,000. Yeah, guys, there's a small error in the revision kit, right? So if you are following it, it's on page 388, because the answer following that is using my answer, right? So it says there in page 388 that after-tax cash flow in year 4, that's this, instead of 13,644, they're saying 16,644. That's a typing error. It should be 13,344. Sorry, 13,644, the number that I have there. Right, so I'll make the change. You also make the change in your books, because after that, the 13,644, when you add 1,250 only, you will get the 14,894 that they have put there. Because it's a typing error. Kaplan revision kit, page 388. It should be 13,644 in this place. Okay, so don't get confused. Right, so let me go ahead and take totals here. Call this the project cash flow. So here it will be 10,168, 11,586, 12,682, and here it will be 13,644 plus 1,250, which is 14,894. So in your revision kit, under project cash flow year 4, the 14,894 is there. Okay, so they have definitely made a mistake there. Okay, and here it's a negative 2,347. Right. Now, can one of you tell me why I haven't included the initial investment over here itself? Did I forget it or shouldn't I include it? Can't remember. Okay. It's not like I have forgotten it, right? It's just that it's now you have to understand that initial investment, guys, is already a present value, no? Okay. So I don't need to do any discounting in year naught for me to get that present value. Now 25 million was initial investment. So the amount that is a present value is also 25 million only. There is no change there. Right? So what I will do is instead of putting it as a separate column here, because if not, it will just be a blank column, I will include that towards the end of the calculation. So I'll get the present values first, and then I will include it towards the end of the calculation. I'll tell you why we do that. It's because it's easier to formulate when you have the numbers like this. But for now, I will just go ahead and do it without any formulas, okay? Right, so now let me discount it. What was the present value? They're saying the real after-tax cost of capital is 7% and the nominal after-tax is 12. So since we have inflated everything here, we can't use the real method. We don't have a choice. We have to use the nominal method only, right? So obviously, discount factor will be at 12%. So go to the tables. 12% for 1 year will be 0.893, 0.797, 0.712, 0.636, and 0.567. Okay, so that's that. Then you can get the present value at 12%. Okay. So then when I'm getting the net present value, what I will do is I will include the initial investment also. So what we do is we take the initial investment, which is again in thousands. There's 25 million, so I can just take it as 25,000. And then I will take the present value of these future cash flows. Present value of future cash flow. So basically, I'm going to add all of these up. Okay. That will be sum, open a bracket, and select all of these cells. So 35,485. So if I want the net present value, I will take a total here. Okay, so minus 25,000 plus 35,000, that will be a positive 10,485. Okay, did you get that answer? Okay. Now I'll tell you why, because when we used to do NPV calculations written, we used to put the initial investment also, right? Here, why we don't do that is because there is a formula that you can use to calculate NPV. Okay. So these two lines, okay. Now get this straight. You have to know how to do these two lines using the tables, because if the question comes in section A or B, you don't have the spreadsheet. Okay. So you have to know how to do it this way as well. But suppose you get this in the section C, you can use the NPV formula directly, right? So what you do is equal sign NPV, okay? And then what you do is you open your bracket and you first type down the rate. So you can see here the rate is 12%. Put a comma and now select all the cash flows. Okay, so you can see that will directly give you this NPV figure. Now, I mean the present value of future cash flows figure. So here it's 35,485. Here it's 35,475. The examiner is willing to accept any answer. Okay, so whether you put it using the tables or whether you do it using the equation, sorry, the formula, he doesn't mind. So what happens here is you don't have to do these two lines. You directly get this present value answer. That's about it, right? So if you want, I'll show you how it's done here. Again, NPV, open the bracket, put the rate, which is 12%, put a comma, select all the cash flows, okay? Don't select the present value itself, that's wrong, right? So select the cash flows. You get that 35,475, you put that as the present value of future cash flows. Then as usual, you take the initial investment also. And then you can get the net present. Okay. So whichever method you use, examiner will give you the mark, right? So minus 25,000, 35,475.19. So even if you say 10,475.19, they will give you the full mark, right? So no problem there. Either way, you can choose. No, you don't have to put this. So if you're going to use the equations, I mean, if you're going to use the formula, you can just omit these two. You don't need it. Get it? You don't need these entire two lines. You can, from this project cash flow line itself, you can go ahead and do the NPVs. If you're putting the discount factors, then at that point, you might as well calculate present value, right? It won't even take you like a minute or two, right? It's up to you. NPV, honestly, using the formula doesn't save a lot of time, but IRR, it does. Okay, so in case there is a situation where you have to calculate IRR, in that case, it's always best if you have the spreadsheet to use the IRR function. Reason is because if you're going to do IRR manually with the equation, you need to calculate two NPVs. No, that will take time. So instead of doing that, if you have the cash flows and you can directly use the equation or the formula in the spreadsheet, that will save you a lot of time, right? So that's that. So in case you want to know how to calculate IRR, just showing you, right? So IRR means you will use this IRR and so select all your cash flows, put a comma and then guess any rate. So if you want, you can just put 20%, 10%, any rate is fine. That will give you the IRR. So probably because this question doesn't have IRR, you can't calculate it. But usually that is the equation. Okay. Right, so you can take this down. This is what your NPV structure will look like. Any questions? Right, so that's the NPV. Then the second is saying calculate the discounted payback period of the planned investment project. Okay, so if you want to get discounted payback, guys, you have to basically use these present values, right? Because if you remember, normal payback, this is how we do it. We take the years, we take the cash flows. Then what do? We say discount factor at how many? 12% in this case. Then we take the present value at 12%. Then we take the cumulative cash flows. Okay, now in this case, we already have this present value answer over here. In year 1, how much it is, year 2, how much it is, year 3, year 4, year 5, how much it is, right? So we don't have to work too much. All we will do is we will put the figures that we need. Okay, so you don't need actually this column itself. This will be negative 25,000. Here you can copy this entire line, right? So 90,080, I'll just type it quickly. 9234, 9030, 9472, minus 1331. Okay. Now let's take the cumulative cash flow. So in year naught, it will be the negative 25,000. Then in year 1, minus 25,000 plus 9,080. So that should give me negative 15,920. Then in year 2, it's minus 15,920 plus 9,234, which will be a negative 6,687. There can be $1 or $2 here and there, rounding, right? Doesn't matter. Then minus 6,687 plus 9,030, that will give me 2,343. Then 2,343 plus 9,472 will be 11,815. 11,815 minus 1,331 will be 10,485. Okay, so if you want to get the discounted payback, you have to look at the point where the negative figure becomes positive, which is between 2 years and 3 years, right? So the discounted payback period will be 2 years and some number of months. So how do we decide how many months it is? basically figure out how long it takes to earn 6,687, right? So in year 3, I have earned a total of 9,030. I want to know how long it takes to earn 6,687. So 6,687 divided by 9,030. That will give me 0.7 years. So it is actually 0.7 years is to get the 6,000 odd. So the entire 25,000, I will take 2 years and 0.7 added to that. So that is 2.7, right? If you want, you can give it as months and years. It's up to you. Okay, so 2.7 years. That is the discounted payback period. 2 marks for this. Okay, then the B part is saying, discuss the financial acceptability of the investment project. Okay, so 3 marks, easily we have answers for 2. Okay, so let me say, based on what I see for the B part, first thing is I will say NPV is a positive 10,485, right? So I will say NPV is positive. Based on this, the project has to be accepted. First point. Okay. Then the discounted payback, what's happening there, right? So discounted payback is 2.7 years. The company has a policy where the discounted payback has to be maximum 2 years. So according to the company's policy, the discounted payback should be 2 years. Since the figure calculated is more than this threshold, based on discounted payback, the project should be rejected. So that's 2 marks there, right? But there is a third point. Third point is now NPV is positive, no? Discounted payback is saying don't accept. NPV is positive, so NPV is saying accept. Okay, so we all know that NPV is only the superior investment appraisal technique. So based on that, although they are both giving conflicting solutions, we have to go ahead and accept the project because NPV happens to be the superior technique. So you just have to mention that. So you can say the correct advice would be to accept the project based on the decision taken after calculating the NPV, since NPV is the superior investment appraisal technique. That's your easy 3 marks. Okay, so 3 points, 3 marks. That's fine. C is saying, critically discuss the views of the directors on Pelta Company's investment appraisal. Okay. Now remember this, when they say critically discuss, you have to kind of, talk bad about what they say. Okay. So basically you have to give the disadvantages or negatively talk with regard to the directors' views. Okay. Now when you take these directors, guys, their views, they didn't mention anything in the first page. Then they're saying something about this terminal value. Okay, now immediately I have a problem with that. You know why? They are actually continuing the project for more than 4 years. They're saying, they told me also here, in year 4, sales volumes is expected to continue for the foreseeable future. So they are planning to continue this project forever. But they're deciding whether or not to accept the project based on only 4 years worth of data. Okay, so their evaluation is based on 4 years, whereas the project on its own is going to be carried out for more than this. So there itself, we have a problem. Okay, so that's the first thing. Meaning, what's the problem? We are doing the project for more than 4 years, but we are taking an investment appraisal decision by only considering 4 years worth of data. So what the decision that we take, it might be inaccurate, first thing. Next thing is, they are taking something called a terminal value at the end of the fourth year. 5% of the initial investment, right? Now, whether that actually happens or not, we don't know, right? Because we are actually continuing beyond this fourth year. So that again seems to be a issue with the way that they are thinking, having the terminal value. The next one is, if you look at the discounted, so if you mention the fact that they're only taking 4 years, that is going to be 2 marks. You mention the fact that they're using an assumption, an assumed terminal value, that will give you 2 marks. And the third point you can mention is, they're saying the maximum discounted payback period has to be 2 years. Now, how did they decide on that 2 years? That's a question to ask, because NPV you can see is at 10,000 it's not 10,000, actually it's 10 million. 10,485,000 positive figure. So it's a big positive NPV. But then still when you do discounted payback, it's actually going past that 2 years. So the validity of this 2-year payback period that they are saying, how true is that? Or should they think of revising that? Because projects with such big NPVs are ending up being rejected because of the fact that they're having this maximum discounted payback period of 2 years. So that seems to be a problem that they need to address. Okay. So 3 solid points, all 3 very clearly given to you in the question. You just need to explain that. Like mentioning it is 1 mark, explaining it is another mark. Okay. So that should give you your 6 marks. Right. So actually the 6 marks, I'm sure even in your exam stress, even then you should easily be able to at least score 4 marks out of that. Okay. So overall, it's an easy NPV question. You get a question like this, you should be happy. Right. So this is the basic thing. The only thing that we did not look at is how to do the working capital adjustment. Right. So make sure that you do a question where there is a working capital adjustment as well. Right. Okay. So since we have to pray, guys, let's take a quick break and come back. Come back at 7:45 and we will do another question. Okay. So I will do another. Yeah, I'll do the next question, Dink company. Then we will do the MTQ based on the time. Okay. So yeah, come back at 7:45. Okay. So let's move on to the next question, which is DINK. Let me go to that. Okay, so this is the lease versus buy. Okay, that adjustment. So like I said, there are two things, right? Now, the reason I chose this question is because, I don't know, somehow I feel that it might be a lease versus buy, right? But like I said, there is another type of question to do with equivalent annual costs. So please make sure that you do that. I told you the question as well. It's that Cabera's company. Okay. Right. So I'll give you a minute to read through this. They're asking, let's read the requirement first. They're saying calculate the present value of the cost of borrowing, present value of the cost of leasing, recommend which one is attractive. Okay. Then B part, something completely different. Discuss general reasons why investment capital may be rationed and discuss ways in which external capital rationing experienced by DINK company might be overcome. So we can think about the theory-based questions later. So again, you can see perfect split here. 10 marks for the, actually more marks for the theory here because there is a recommendation. So 11 marks for theory and 9 marks for the calculation. Okay. So have a go, see if you can figure it out, and then I will do it as well. Okay, so let me read it through. It's saying, DINK company is a small company that is finding it difficult to raise funds to acquire a new machine costing 750,000, right? Now, when I read that small company itself, finding it difficult to raise funds, that may be a point I can mention somewhere because whenever you read something and, it's something interesting, something new, just, keep underline it. I mean, just keep a note of it. Okay, because you might be able to include that somewhere in your answer. Dink Company would ideally like a 4-year loan for the full purchase price at a before tax interest rate of 8.6% per year. The machine would have an expected life of 4 years. At the end of this period, the machine would have a residual value of 50,000. Tax allowable servicing costs for the machine would be 23,000 per year. Okay, so we are buying it for 750. We can sell it for 50,000 after 4 years, and they're saying there is a servicing cost for the machine, which is tax allowable, meaning you can deduct it from your, your cash flows. The tax authorities allow it.
There's
So,
one question.
yeah.
Normally, when we used to practice, when we were first learning the theory back then, we learned that tax allowable depreciation is the only relevant cash flow for cost of buying, right?
What did you say? That's the relevant cash flow for cost of buying?
The tax allowable depreciation.
Yeah.
But in this case, do we have to consider this 23,000 factor also?
Yes. Because usually we don't have this situation where there is a 23,000 per year that they see, tax allowable depreciation, Akib, also is a deduction that the tax authority allows you to deduct
Yeah.
as a substitute for depreciation. Likewise, here they're saying there's another cost also which you can deduct. So if there is something that the tax authority is allowing, you can deduct it. But like how tax allowable depreciation attracts a tax benefit, this 23,000 also will attract that same tax benefit. Got it?
Got it. This 23,000 is anyway the loan amount you have to pay, right?
No, it's a servicing cost, means like most probably if you have a machine, it's not the amount that you have to pay the bank. It's like it's maybe, some a technician has to come and, service it every year or something, change the oil and all of that. So that expense is only that 23,000 servicing cost.
Then it is anyway relevant for our calculations, no?
Sorry?
Then it is anyway relevant for our calculations, right?
Yeah, relevant. Because if it was not relevant, then they will tell you that the tax authority will not allow such a deduction. Here, since they're allowing it, we don't have to worry.
Right, okay.
Right, so that's the paragraph about the buying option. Then the leasing option, they're saying, a leasing company has offered a contract whereby Dink Company could have use of the new machine for 4 years in exchange for the annual lease rental payment of 200,000 payable at the start of each year. That's normal. Usually lease payments we pay in advance only, right? The contract states that the leasing company would undertake a maintenance of the machine at no additional cost to Dink. At the end of 4 years, the leasing company would remove the machine from the manufacturing facility of Dink Company. We're paying corp tax 30% 1 year in arrears. Fine. What you have to remember when it comes to the lease versus buy decision. Okay. So first you have to remember the cash flows that we have to include. Okay. So first, under the leasing option. Okay. So I'll take leasing first. The first cash flow you have to remember is the lease payment itself. These are the relevant cash flows. And the second one is the tax relief on lease payments. These are the two cash flows we have to consider under leasing. Okay. Then under borrowing or buying. Yes, I'll call it buying itself. Again, there are two cash flows like how you mentioned a minute ago. Number one is the purchase price and scrap value. Number two is tax savings on tax allowable depreciation. These are the usual two cash flows that we have to include. In addition to this, one more thing they're telling us here, Dink Company would ideally like a 4-year loan for the full purchase price at a before tax interest rate of 8.6, right? When it comes to leasing and buying, we don't use before tax interest rate. We always use the after tax interest rate. Okay. How do we calculate this after tax interest rate? We take the before tax rate and you multiply it by 1 minus the corp tax rate. Okay, so before tax we had that as 8.6, that you multiplied by 1 minus corp tax rate, which is 30%. So first off, let me get the after tax rate because that's what I need to use. That will be 8.6% multiplied by 1 minus 30%. Okay, so I should be careful. The rate that I use should be 6%. Okay, So now let's go ahead and try the present value for the cost of borrowing for this particular machine. So that is A1. Okay. So let me do borrowing. So the years I have is 0, 1, 2, 3, 4. They're telling me it's a 4-year life, right? Yeah, we have an expected life of 4 years. But I'll take the 50 also because we are paying taxes in arrears, no? So 5 I might need. So 2 cash flows I have to consider. First one is the purchase price. Okay, so that is, they're telling me it is 750,000. Happens in year naught. Scrap value is also relevant. They're saying that is 50,000 at the end of this 4-year period. So in year 4, there will be that scrap value of 50,000. Okay. So I have taken the purchase and scrap. Now I have to take tax savings on tax allowable depreciation, right? So to get this tax savings on tax allowable depreciation, we use the same format that we used here. You can even copy it and take it there. Okay, this is the same format that you will have to use, right? So you have the years, the cash flows, the tax savings, and the timing, right? So if you look at the tax allowable depreciation, in year naught, we have the investment, which is 750,000. I think this one we can do it, we don't need it in thousands, no, it's just 750. No? So that is a 750,000. Okay. Then what happens in year 1, we will claim our first tax allowable depreciation, which they told me was 25% reducing balance basis. So tax allowable depreciation, 25%. Okay. So 25% of 750,000 is 187,500. Okay. So tax savings will be, corp tax is 30%. So 30% of the tax allowable depreciation is only going to be the tax savings, which is 53,550. Let me just check if the numbers are there. 30% of, sorry, it's not 178, it's 187. Okay, so problem with the number. So it should be 56,250. That's the tax savings, right? Have the written down value here. 750 minus this. Okay, so 562,500. Do the same for year 2 as well. %25 of 562,500. And then the tax savings will be 30% of that answer, 146,25. Written down value will be 562,500 minus 146,25. Okay, so same thing, year 3 also no problem, right? Only year 4, that scrap thing comes into the play. So 25% into the written down value. And here it will be 30% into the answer that you got previously. Okay. So you again have your written down value as this minus this, which is 316,406. Okay, so let me just make all of these whole numbers. Right. So now this is the written down value after year 3. Year 4, what happens? You have the scrap, right? So residual value. You're selling it for 50,000. So then you can see whether it's a balancing allowance or a balancing charge. 266,406, that is obviously a balancing allowance, right? Because it's a positive figure. So then you will make again a tax savings of 30% of the balancing allowance. Okay, so 79,922, that will be a savings, right? So now timings, let's be careful with it. Again, we are paying 1 year in arrears, so we don't have to worry. Year 1, we claim the first tax allowable depreciation, means timing happens 1 year after that, which is in year 2. So this will be year 3, year 4, and year 5. Okay, so all of these numbers you can copy it down here, calling it the tax relief. Tax allowable depreciation. Okay, so first is this 56,250 that happens here. Then 42,188, then 31,641, and finally we have a 79,922. Okay, so until year 5, I have put all the figures, right? What else? Let me see. Yeah, so then the question is talking about something called a tax allowable servicing cost. Okay, so they're saying tax allowable servicing cost for the machine would be 23,000 per year. And that's it. They're not mentioning anything other than that. So now we are going to have an additional cash flow just for this question. Okay, so usually this is it. We'll have the purchase, scrap, tax relief on tax allowable depreciation. That's it. Here you will have this service cost. Okay, so you can actually deduct this from your cash flows. So how much is that? Every year, 23,000 you will have to pay. So I'll put that as a negative figure. So year 1 to year 4, you will have this 23,000 service cost. Okay. What else? Now, if the tax authority is letting you to deduct the 23,000, guys, that is actually reducing your profit. That means if anything is reducing your profit, you will earn a tax savings because of that. So this 23,000 also gets a tax relief on service cost. Okay, so I'll just put it as service. So this 23,000 also you can expect to get a relief. So 30% of 23,000 you will get a tax relief, but you won't get it immediately because we are paying 1 year in arrears. You will get it the next year, right? So 30% of 23,000, but it won't be a negative figure because it's a tax relief. No, tax relief is a positive thing. So just put the number 23,000. So 6,900, you will get a tax relief. So that will happen for year 2, 3, 4, as well as year 5. Why? Because we are paying 1 year in arrears. So this 23,000 relief happens in year 2. This 23,000 happens in year 3. This one happens in year 4. And this one happens in year 5. Okay. So that's basically it. Those are the only cash flows that we have to consider. Now we can get the present value. Okay. So let me get the net cash flow. So it will be minus 750,000. Here it's minus 23,000. Here you can't formulate it because you have a negative figure. So you can just take the answer there. 4150. I mean, you can write if you want, you can add everything. That will also give you the answer. 26,088, 65,541, 86,822. Okay. So those are the net cash flows. Discount factor, we already got the percentage we're supposed to use, which is 6%. Year 1 is always 1. Then you can go to the tables and get the discount factors. 943, 0.943, 0.890, 0.840, 0.792, and 0.747. Okay, so those are the discount factors. Go ahead and get the present values as well. So again, minus, let's take the multiplication. Okay, and then you can take the yeah. So now you have all the present values, so you can take the net present value also. Okay, so take the sum of all of these figures. So the present value of the buying option will be a negative 597,277. Okay, so let me call this the, don't call it the net present value, right? Because this is not an NPV, no, they're just doing the option of borrowing. Okay, so let's call this the present value of the borrowing option. So this we will have to compare it with the present value of the leasing options. Right? So that's it basically. Take it down if you haven't. And then let's get the present value of business. So you get 6 marks here, guys. Okay, it's not a very complicated calculation, but a easy 6 marks. And you can think about the present value of leasing, okay, and how that goes.
Payable at the start of each year means is it on advance or arrears?
Sorry, come again, Akif.
Payable at the start of each year means is it arrears or advance?
Advance. Start of the year is advance.
So we are having the leasing cash flow from the year not onwards, right?
Yes, correct. Okay, so let me read it. It's saying, I just need to look at the second paragraph, right? A leasing company has offered a contract whereby Ding Company could have use of the new machine for 4 years in exchange for an annual lease payment of 200,000 payable at the start of each year, right? So let me get the years straight, okay? So I have the years 0, 1, 2, 3. Oh, I'll put 5 also. Okay, now understand that if you're going to pay something at the beginning of the year, it has to be in place today itself. Because now even if you're going to pay it on the first day of year 1, at the last day of year not, it has to be there. Okay, so this, they're saying 4 years in exchange for annual lease payment of 200,000 means at the beginning of the year it should be there, means first lease payment has to happen in year not. Okay, so that will be a 200,000 here. And they're saying it's a 4-year lease. No, so obviously you have to make 4 payments, right? So 200,000 in year not. And then in year 1, year 2, year 3, that's it. You have your 4 payments. Okay, so it doesn't have to go until year 4, right? Now, get this clear, guys. Usually, this 200,000, right, that's highlighted here, although we put it under year naught, the payment actually goes through on the first day of year 1. Okay, so for the purpose of taxes, what happens is any tax savings, now lease payment also is something that's going to reduce your profits, right? So that will give you a tax savings of 30% on this 200,000. But the 30% you will not realize it in year naught. Okay, because like I said, the actual 200,000 that you pay, the tax authority will call and ask you, when did you pay this 200,000? It would have happened on the first day of year 1. Okay, so any tax relief, you can only claim it for year 1. But then again, year 1 also is too early because we are paying taxes 1 year in arrears now. So any tax for year 1, we will pay in year 2. So any tax savings for year 1, you can only claim it in year 2. Okay, so if you're talking about the tax saving situation, you get a 30% of 200,000, but the savings happens not for year naught, it happens for year 1, right? So that is 60,000 happens in year 1, year 2, year 3, and year 4. That's
Actually,
fine. But still, we can't claim it on the same year. So the tax claim happens again 1 year later, right? So this has to move by 1 year. Okay, so like I said, the 60,000 is a savings that happens for year 1's figure. I'm not arguing there. But the thing is, we can't claim the 60,000 in year 1 itself because we are paying 1 year in arrears. Okay, so that's why it has to move to the next year. So the claim happens from year 2 onwards. So be careful there.
Another thing is, if this lease payment was payable in arrears, this scenario could have changed, right?
If the lease payment was paid not at the end of the year. If they said the lease payment was paid at the end of the year, then the scenario will change. It will be the normal situation. But Akib, usually lease payments work like this.
Yeah, in practically.
Yes. Okay. So I'll put this as a negative figure so it's easier for me. It's a payment, no? Okay. Right. So those are the only 2 things I have to consider, right? Look here. I have to look at the lease payment and the tax relief on lease payment. Both I have looked. Okay. So tax, I'll call this tax relief instead of claim. And now I can take a total here. So let me call it the net cash flow. So here it will be minus 200,000. Sorry. Okay. Then here it will be minus 200,000 plus 60,000. So that is a minus 140,000. Same here as well. Here it will be 60,000. 60,000. Right. So I have the net cash flows. Let me take the discount factor again at the same 6%. I already took it, I think, somewhere here. Yeah, then I can get the present value at 6%. Okay, and then let me take a addition. So I'll call that the present value of the leasing option. That will be the sum of all of these values. That will be 538,460. Okay, so don't worry, it will be negative, right? So when you're doing buying and leasing, the present value that you get will be negative because we are only taking cash outflows. No, we are not taking any sales figure for an inflow to come and show the positive NPV, right? So that's why I don't call it the net present value. I call it the present value of the leasing option. So now what you do is compare the 2. So second one is also done. Third is saying recommend which option is more attractive in financial terms, right? So if you look at the borrowing option, it's 597,277, whereas this is 538,460. So very clearly the leasing option is cheaper. Okay. So the recommendation would be to go for the lease. What's this company's name? Dink Company. Should opt for the leasing option since it is cheaper. by how much was the figure? You can just figure it out here. 5, how much is it? Yeah, 597,277 minus 538,460. Cheaper by $58,817, right? So because of that, we will go for the leasing option. Right? So that is your 9 marks, right? No, 10 marks there. Okay. Then B is saying, discuss general reasons why investment capital may be rationed. Okay. So if you look here, they mentioned something. They said it's a small company. They're finding it difficult to raise funds. So something around raising funds, they have to include, right? So that's what the B part is about. Now they're asking you, why will you have a rationing when it comes to your capital? Okay. So 6 marks, of course, now it's like this. When you have marks, how you have to think is like this, right? If you have 4 marks or anything less than 5 marks, think of making 1 point per mark. So now, if, for example, B part second one, 4 marks, so try to make 4 points. Okay. But the moment the mark is more than 5, try to make 1 explained point for 2 marks. So 6 marks means try to make 3 explained points. Okay, that usually will work for you. So like I'm saying, get this straight again. If it is 5 marks or less, then make 5 points itself, because we might not be able to explain properly. But the moment it becomes more than 5, now for example, here you have 6 marks, it's going to be very difficult for you to think of 6 different points, right? So in that case, most probably the answer will be 3 explained points. Okay, so that's what you have over here. So it says here, discuss general reasons why investment capital may be rationed. Okay, so what I can think of is there are 2 types of rationing, right? So one, there can be hard capital rationing. So that is where somebody external to the organization is putting putting a cap to how much we can borrow. For example, you can say a lending institution may have already lended us with a lot of money, and at one point they start refusing to provide further finance. So at that point, the company, whether they like it or not, they won't be able to raise more finance. So that is called hard capital rationing. Then the second thing that I can think of is soft capital rationing. So when does this happen? This is when within the organization itself, we decide that we are going to put a cap on our investments. Okay, so there could be many reasons why we are doing that. For example, we might want our departments to actually compete for funding. So that way, what will happen? We only invest in the most profitable projects. Okay, so there can be other reasons also. Like, for example, we might be wanting to maintain like an organic growth. So we don't want to invest too much. We will invest only a particular quota. After that, we will refuse to invest any further in our business. So different reasons for soft capital rationing also can be given. So that will give you your 6 marks easily. Okay, that's B part 1. The second one is saying, discuss ways in which the external capital rationing experienced by Dink company might be overcome, right? Now I can see that Dink company is a small company. Okay, so small company means most of the time they fall under the small and medium enterprises. So the most probably the reason they are not able to raise funds is because banks and major lending institutions, they are not willing to give them the money because of the risk factor. Okay, so for them, most of the time, they can think of what we call business angels. Okay, so business angels are people who are wealthy. So wealthy individuals who are willing to invest in the business without any security. But at the same time, they might ask for a particular percentage of ownership, or they might, come and put in their input in terms of running the business. So those kind of disadvantages are there. But then again, end of the day, you get the finance. So you might be thinking of that as one option. Second thing that you can think of is usually small, medium enterprises, they have the option of government aid. Okay, so in case that you live in a country where the government actually helps small and medium enterprises, we call that a particular type. I no need to go into that. You can just say, get government aid. That will also help. Okay, so actually we call that a supply side policy, especially if this company is a in the private sector. Okay, so sometimes the government, if you're in the private sector, they try to give you as much aid as possible. So you thrive because of the fact that usually public sector companies tend to be less efficient. Okay, just mentioning that. So government aid is another point. Another thing you can think of is maybe go for something like a crowdfunding, like a GoFundMe pages. You can write, right? GoFundMe is perfectly fine. So you can go for crowdfunding, where small amounts will be transferred to you by different individuals, maybe your family or friends, any external parties. So that way, what happens with time, you will get the finance that you need. How else can you raise finance? Maybe you can ask somebody to become your partner. So something like a joint venture. Okay, so maybe now it is 100% owned by one party. They can think of bringing another person, external, give them a little bit of shares, give them ownership. Yes, your control will be diluted, but that comes at anything will come at a price. So the fact that you need investment will come at a price, and that is the fact that you lose a little bit of your ownership. What else? Yeah, that's the max I can think of, right? So I mentioned, I think, 4 things. I mentioned go for a business angel, go for government aid if it's available, go for crowdfunding, or go for a joint venture. Okay, so those 4 things, if you mention it, you will get your 4 marks easily. Okay, so this is how you will be able to get it. So that's why if you can think of 4 things, then write 4. But if you feel that the mark is too much, then try to mention it and explain. Okay, that will also be okay. So that is your 20 marks. Yes, that is Dink company, right? So if you want, I'll just show you the answer to this. It's in page 408. Let's see if we mentioned it. Yeah. Okay, so reasons why investment capital may be rationed. Just read through what is highlighted, right? So it's saying the objective of maximizing shareholder wealth can be achieved in a perfect capital market by investing in all projects with positive NPVs. But some companies experience capital rationing where there is limited amount of investment finance. So then they're talking about hard capital rationing, what it is, and soft capital rationing, what it is, right? Then hard capital rationing, company specific. For example, they can't raise new debt if banks or investors see the company as too risky. Then soft capital rationing is if you, as part of the policy of controlled organizational growth, you don't want to suddenly increase your size. So that's why the managers are giving you a quota. So one reason for it is maybe we want investment projects to compete for funds in the belief that it will result in the stronger and more robust investment project being accepted, right? So you can just read through these and get ideas with regard to how to answer the theory-based question. Ways in which they can overcome external capital rationing. So they're saying it's a common problem that this company is facing called the funding gap. Okay, so we didn't mention it. The funding gap, where small, medium enterprises, they find it difficult to get the funding that they want. Okay. So one is you can go for business angels. I mentioned that. Crowdfunding, that's another one. See, for example, internet-based platform. Then you can go for aid from the government, or you can go for a joint venture, or they're even saying evaluate whether Islamic finance, for example, an Ijara contract may be available. So if that is also available, you can go for it. So whatever you can think of, you write 4 points. If you write, you'll get your 4 marks easily. Okay. Right. So that is it. Yeah. So let's do the last MTQ that I wanted to do today. That is, what was that? I think it was bill company. Let me check the page number. No, not bill. Yeah, bill. Yeah, bill company. That is page number 68. Okay, so just to show you how to handle an MTQ. 68 minutes. Okay. So there we have investment appraisal. Okay. Have a read through quickly and see if you can figure out what they ask. Okay, so it says here, Dell company has decentralized and divisional managers are allowed to make their own investment decisions subject to confirmation by the main company board. So the main company is Bell. They have decentralized, meaning they have different, departments, and each of them can make their own decisions. Because each of the three divisions, Ding, Dong, and Merry, are subject to different levels of risk, it has been thought appropriate to use different discount rates in each division. Okay, so the discount rates for each of the divisions are going to change. Then they're talking about Ding. Ding has been told that its real discount rate is 5%. The general rate of inflation based on an index that uses a very wide range of prices is 2%. In the industry in which Ding operates, a number of prices are seen to be inflating at 3%. Fine. So they're giving me the real discount rate, the general rate of inflation, and the industry inflation rate. Okay, so general rate, industry inflation rate, and the real discount rate is given. That's Ding. Then they're talking about Dong. It's saying Dong is assessing a project in which the first of 4 annual lease payments has been agreed at 120,000. This is payable in 1 year's time, and subsequent payments will rise by 4% per year. Okay, Dong's proper money cost of capital is 8%. Merrill is considering investing 1 million in a project which will produce the following annual outflows and inflows. So you have the outflows and the inflows, they're giving it to you. The cash flows which arise at the end of the year are stated in current year terms. It is expected that outflows will rise by 3% per year and inflows by 2% per year. The money cost of capital of Merrill is 9%. Okay. So let's look at the requirement. First, they're asking you for Ding's money discount rate. So you have to look at only this paragraph here, right? So Ding, basically, they are just asking for the money discount rate. You just need to use the Fisher equation, okay? So Fisher equation, one plus the nominal rate should equal to 1 plus the real rate times 1 plus the rate of inflation. Okay. So they're asking me for the money rate means they're asking for I. Okay. So 1 plus I should equal to 1 plus the real rate, which is 5%, multiplied by 1 plus the inflation rate, which you have to be careful, right? You have to use the general inflation rate. This is always general inflation, not any specific inflation rate. So that is 2%. So rearrange the equation, that should give you I, which is 7.1%. So the answer will be A. Okay, so that is going to be D. Then they're talking about Dong. They're saying what is the present value of Dong's last payment that will be made in 4 years' time to the nearest $1,000, right? So look at Dong. They're saying Dong is assessing a project in which the first of 4 annual lease payments has been agreed at 120,000. This is payable in 1 year's time and subsequent payments will rise by 4% per year. Okay, so they want to know the present value of the payment that happens in year 4. Draw timeline. The first payment is happening in year 1. They're telling me payable in 1 year's time. That is going to be 120,000. Then in year 2, it will be 120,000, but it will inflate by 4%. So into 1.04. Then in year 3, it will be the same 120,000, but this time it will inflate by 1.04 squared. And here in year 4, the payment will be 120K into 1.04 cube. Okay, so in this year, it will be 120,000, which is the base, but it will inflate for 3 years, although it's happening in year 4, for 1.04 to the power 3. So that means the payment will be 134,984. So that's going to be the payment. Okay, so in year 4, you will have to pay 134,984. But you can't stop there because they are asking you for the present value. Right, so this 134,984, you will have to discount it. They're telling me the money cost of capital is 8%, right? So all you have to do is take the 134,984 multiplied by the discount factor at 8% for 4 years. Okay. So go to your tables and get that number, which is how much? 0.735. Okay. So that will make it 99,213. So the nearest 1,000 they're asking. So you just put it as 99,000. Just put 99 here. Okay. So you have to be careful with the timings here, right? So you can see why people get stuck with MTQs is, guys. In the section C, we would have done all this, like, something to do with year 1, year 2, year 3, everything you will do. So you would have properly inflated it. Now here, because it's only a year 4 payment, sometimes people might think, okay, 120 to 1.04 to the power 4 because 4 years. But actually, if you draw the timeline, you realize, no, the year 1 was 120 means this has to be 1.04 to the power 3. So because we are doing bits and pieces of the calculation, there is a tendency where we can go wrong. Get it?
Another thing in this question is, even I got tricked when I did this back then. I confused with this 1 year's time. So I confused with it. It was starting in year note itself. But if they had
Yeah,
said if it is
exactly.
starting,
Because usually lease payments, they happen in year not. But here they very clearly said it's payable in 1 year's time. That's also a place where you can get tricked. That's true. But that's what I'm telling you, Akib. When it comes to MTQs and MCQs, they trick you. Unlike the section C. Okay. So you have to always read it and, work carefully with it. Okay. So let's look at merrily. What are they talking about merrily? They're saying merrily is considering investing 1 million, okay, in a particular project. And there are cash flows, outflows as well as inflows. And they're saying that outflows you will have to inflate by 3%. And inflows you will have to inflate by 2%. Okay, so let's first inflate it. Okay, so inflows inflated, okay. So we have year naught, year 1, year 2, year 3. Year naught, there is no inflow. Here there is an inflow of 2,000, but you have to inflate it by 2%, right, into 1.02. Then in year 2 also there is an inflow, that is 3,000, but this you will have to inflate again by 1.02 to the power 2. That is 3,121. And then here you have a 2,000, but again inflate it 1.02 to the power 3. Okay, so that is 2,122, right? So those are the inflows inflated. Now you can inflate the outflows. So year 1, it was 1,800. Inflated at how many percent? 3%, 1.03. Then here it is 2,500, again inflated at 1.03 to the power 2. And here again inflated at 1,500, inflated at 1.03 to the power 3. They're doing everything to the nearest 1,000. So I'll just make these all whole numbers, okay? Right. So after this, we can consider the investment also because it's MTQ, no? So we don't have to do any, we can't formulate anything even if we want to. So it's 1 million, but we are doing everything in thousands. Be careful. So it will be 1,000. Okay, so it will be 1,000 over here. Right? Yeah, I don't think I have missed any other cash flow. So I can go ahead and take the net cash flow. Minus 1,000. Here it's 240. Minus 1,854, 186. Here it's this minus this. Yeah. So minus 1,000, 186, 469, 483. Okay. So then they're telling me the money cost of capital is 9%. So I will take discount factor at 9%. So here it will be 1. Go to your tables, 0.917. 0.842. Now this you have to do manually, right? You don't have a choice because you wouldn't have a spreadsheet with you. 0.772. So you can't use the NPV formula here. You have to know to do it manually. Present value at 9%. So that will be this. Okay. And let me take the net, they're asking for the net present value, right? To the nearest 1,000. That will be a negative 61.45. So let me see if there is a 61,000 negative. Yeah. So the answer will be D. Okay, so simple, but there are tendencies, right? There are points where you might go wrong because there are two different inflations and the starting point is not the same. That's the only thing over here, right? Because if it was only 1,800 and inflation Sorry, I'm so sorry, Akib. I had to keep you waiting 5 minutes just for the last two bits, right? Thing is, I had my phone on. I didn't realize that it had lost charge.
Right, okay.
Right, okay. So just the last bit. Right, so it says here, when considering risk in project appraisal, what's the main advantage of using simulations, right? So like I said, sensitivity analysis, you can only, you can check, okay, what will happen to NPV if the selling price increases? Okay, what will happen to NPV if something else reduces? Okay, but we can't figure out what will happen to NPV if maybe 2 or 3 factors change at the same time. For example, selling price increases and maybe some cost is decreasing, and then maybe the discount rate is changing. So something like that you can't consider when it comes to sensitivity analysis, right? So it's not very practical, right? Because in real life, so many things can change at the same time. So the only method, the only technique where you can analyze or forecast something with so many changes is simulation. Okay, so obviously not something that can be done manually. It has to be done using a software. So that's the reason why we don't learn how to do it in an exam, but you should know to explain what it means, right? So they're asking you what's the main advantage. Main advantage of simulation is so many things can change at the same time, like how it does in real life. Okay. So a clear decision rule, no, most of the time that is to do with NPV, right? Because positive accept, negative reject, that is NPV. More than one variable can change at the time, that is only simulation. Okay. Statistically more accurate than other methods as NPV. Being diagrammatic is easier to understand. Now, actually, you can maybe call IRR little diagrammatic, but simulations have nothing to do with diagrams. Okay. So D will be, answer will be B. E part is saying, is it possible to have a negative real discount rate to apply to the cash flow estimates made in current terms when making investment decisions? You have to decide whether it's yes or no, and you have to decide on a reason also. So I'll show you the Fisher equation. They're talking about this real rate over here. This rate, they're asking you if there can be a situation where this rate can become negative. Okay. Now, if you don't know anything about it, the only thing you can think of is, okay, let me just put random numbers and see if at any given point this rate is becoming negative. Okay. So you take your cal if you want. Okay, because I know we have never, spoken about this, right? So I'll just put a random nominal rate. So 1 plus, let me just put it as, say, 14%. Okay. Alpha equals to 1 plus, I want to know what's happening to the R, right? So I'll put R as X. And 1 plus H. So 1 plus, let me just put a random inflation rate, let's say 5%. And shift solve and let's see what's happening to R. Okay, so I can see it is positive 0.85 means 8.5% is only R. So this is a normal situation where, we have the real rate, inflation rate will be there. Most of the time, the nominal rate will be more than both the real rate and the inflation rate. So when can this be negative? Okay, so I can only think, when I look at this equation, I can only think of one situation that I have never come across. What is that situation where this H is more than I? And most of the time, when I have I, the nominal value, that will be more than both the real rate and the inflation rate. Let's say a country is doing really badly in terms of inflation, their prices are increasing badly. Suppose, let's say the general inflation is more than 14%. So let's just make it 25%. We see what's happening to R. Solve it. Can you see it's becoming negative? Okay. Now, nobody can tell me that inflation can't be 25%. Like in our Sri Lanka, it was even 300% at one point. Right? Nominal rate is a combination of both the inflation as well as the real rate. So nobody can tell me nominal means it has to be lower than the inflation. Not like that, no. Right? It can be lower, it can be higher. So if this inflation, for some reason, which it has happened in many countries, if it happens to be more than this nominal rate, I do find myself in a situation where the real rate happens to become negative. Okay. So mathematically, you can figure that out. So yes, the answer is possible. Let's decide on a reason. It's saying the calculation of a present value won't work if the discount rate is negative. Okay, you can't get a present value if the discount rate is negative, yes. But the discount rate that you use is the nominal rate. Nobody is talking about a negative nominal rate here. We're talking about a negative real rate. Okay. So it's not really answering the question. They're asking, can you have a negative real rate? But has that got to do with the present value of a discount rate being negative, right? So that doesn't make sense. Negative interest rates never happen in the real world. That is wrong. There are situations in the world where you can have a negative interest rate. Okay. It will happen in deflationary time. Deflation means there is no inflation. That means your H is actually lower than I. That situation also, it won't be that. Then in that case, R will be a positive figure like normal. It will happen if the rate of inflation exceeds the money cost of capital. That is what we also saw. When we put IS 14 and HS 25, we realize that this R is becoming a negative figure. Okay, so yeah, that is the answer. Okay, so yes, and it will happen if the rate of inflation exceeds the money cost of capital. Okay, so let me just show you the answer for that as well. This is 221. Because I think they would have explained all of that. 230. So it's in page 230. Okay, so Bell Company, this is the calculation. Yeah, see? Okay, that I'm telling you a story. You can read if you want. This was a situation that was highlighted by Brian Carlsberg and Tony Hope in the 1970s at a time of high inflation in one of their books. Okay, so I don't know if I usually tell it in class. I know you have listened to me saying this. There will be one question that is, there to differentiate a 90% student and an 80% student. This is that question. Okay. With the current state of low interest rates, the situations may be just as relevant today. Okay, so they're saying reason A is not correct. Okay, so I'll read out what reason A was. Reason A, they said the calculation won't work if the discount rate is negative. Okay, the only negative discount rate that makes calculating an NPV tricky is minus 100%. You may use a spreadsheet to calculate NPV of a simple project for a range of discount rates from minus 200 to plus 200. That's something you have to learn, right? Now, it's difficult for us because in our tables, we don't have negative rates, okay? But otherwise, if you use the equation, you can find discount factors for negative rates also. But that's why they're saying there is one tricky rate, 100%. Because when you use 100%, it will say math error. Okay, so you won't be able to do it, but otherwise it is possible, okay? Then we have reason B. What is reason B? They said negative interest rates never happen in the world. Okay, so then reason B is not correct. Since there have been many instances of negative interest rates, the European Central Bank recently introduced negative rates, which have also been seen in Sweden, Denmark, and Switzerland, it seems. Okay, so you can just know that. It will happen in deflationary times. Reason C is not correct because since deflation is likely to increase the chance of having a positive real discount rate, unless the money cost of capital is even more negative. So like I said, if there is no, when there is a deflation, meaning that H figure is low, very rare for the R also to be negative unless the I is lower than that. Okay, so the I also should be lower than the H figure, then yes, otherwise R will be a positive figure. Okay, so that's why the answer will be D there. Right, so that is it for Bell Company as well, Akib. Okay, so I have covered investment appraisal except for the area where we look at EACs. So please look at that, plus investment appraisal, the working capital adjustment. Okay, so in NPV, working capital adjustment, I have not looked into. Otherwise, more or less, everything is looked into, but please finish off all the questions, right? You have enough and more time to finish off all the questions that need to be done, right? So that's it, Akib, for today. I will see you. Yeah, so I will have a class on Sunday. Okay, that will be physical, I believe. I will anyway update you on that. So we did a mock exam last Sunday. I'm not sure if you have done it. I think you might have done it previously, but I have to discuss that mock exam. Okay, so that will happen on Sunday. Monday will be another TRG. I will look at cost of capital. And then after that, the following Monday, the following Sunday, there will be a mock exam, which I want you to attend as well, because that will be a new one. So you attend that and the next,
This coming Sunday.
sorry?
This coming Sunday.
Yeah, so yeah, to give you the proper, 1 second.
That mock 2 paper we did in the previous March intake actually.
Yeah, that's what you have already done that, right? Yeah, I think you would have already done that, but that's what now. So TRGs, all of it will be new to you, right? So TRGs on Mondays you can attend. That will be completely different. On Sundays, now the coming Sunday, I will go through that mock. So you might, it might be something that you already listened to. But the next 2 Sundays, the last 2 Sundays of the month, August, on one
Yeah.
Sunday, I will do a mock exam physical. Okay, so you also come and do it because it will be a new one. And the following Sunday, I will go through that also will be physical. So that also you can attend, right? So if
Okay.
at all you want benefit, it will only be the coming Sunday.
Okay.
Okay. Right.
Okay.
That's it, Akib. I'll see you then. Okay.
Okay. Good night.
Okay. Good night.